Okay, so now we're gonna look at another case. Well, it's the same Horizon Petroleum, but there is a new scenario. Um, right now, let's suppose that Horizon Petroleum is not using the market transfer pricing, but rather they're going to apply the full cost based transfer price. So they're gonna make internal transfer at 105% of the full cost. Right? So 105% of full cost means 5% is gonna be the margin that goes to the selling subunit. Recall that the refining division purchases 20,000 barrels from the local Houston supplier at $85 per barrel. But now, in order to reduce the crude oil cost, the refining division found an independent producer in Matamoros, Gulfmex Corporation, that is willing to sell at a lower price of $70 per barrel of crude oil. First off, the transportation division will receive the crude oil from Gulfmex once they do business with Gulfmex, and then transport it to Houston and sell it to the refining division. If the pipeline has a unused capacity, then the transportation division would only incur the variable cost of $1 per barrel. All right. If there's no unused capacity, then the transportation division would have to not only incur the variable cost, but also consider increasing their fixed cost. Right? But right now, we're going to think about a case where the capacity is unused, so that the transportation division would only incur the variable cost of $1 per barrel. This is the same visualization, but there's a new situation that I have added in red, right? So the alternative one was the original way they do business with the supplier at Houston to buy the crude oil at $85 per barrel. So based on the external market price for the 20,000 barrels. The another alternative they are thinking is to get a supplier from Matamoros at $79 per barrel, right? And then that would incur the variable cost of $1 for the transportation division, right? Let's look at both the company perspective and the selling subunit perspective. Let's calculate what is going to be the incremental cost under the two alternatives. Then, oh, well, let me make it clear here. So we're going to look at the company perspective, and then the second one, we're going to look at the buying subunits perspective. Okay. So right now, we're going to look at the company perspective. So there are two alternatives that I have introduced. Alternative one was the original way, where they buy the barrel from Houston supplier at $85 per barrel. So that would leave us with 20,000 barrel times 85, $1.7 million, right? But if we take the alternative two, then they're going to buy the 20,000 barrels from Gulfmex at $79 per barrel and then incur the additional variable cost from transportation division at $1 per barrel. So that would be 20,000 barrel times $79 plus $1, so $80 per barrel, right? That would leave us with $1.6 million. So from the company perspective, it makes sense to move from alternative one to alternative two, right? However, from the buying unit perspective, they're gonna be set the transfer price based on the full cost, 105% of the full cost of the transportation division. Then how would the the transfer price look like? Under the alternative one, the purchase price is the same as the company perspective, which is 20,000 barrels times $85, yielding $1.7 million. But under the alternative two, if they are gonna buy based on a full cost, then it looks like this: 20,000 barrels times the 1.05, which is right here, times 79 plus variable cost of $1 plus the full fixed cost of $3, right? Because here we're interested in purchasing based on a full cost, including both the variable and fixed, right? Then that would lead us to much higher cost of $1,743,000. So from the refining division perspective, they would not choose alternative two, although choosing alternative two makes more sense from the overall organization perspective. So that would actually lead to goal incongruence situation. The alternative approach exists. So based on the alternative approach, we can actually use the variable cost base rather than the full cost base. And this makes more sense because in the unused capacity setting, the fixed costs do not change, right? The only thing that changes is the variable cost. So we should only set the transfer price based on a variable cost, right? So now the new incremental cost would look as this: 20,000 barrels times 1.05 times $79 plus $1, yielding $1,680,000. Okay. So this was the cost-based transfer pricing. Last is the hybrid transfer pricing. Hybrid transfer price has a range, right? Usually, now we're gonna be using this second scenario example throughout. Okay. Um. Then what is going to be our price? So when setting a price, there is always gonna be the minimum price and the maximum price. So minimum price actually comes from the selling subunit, right? What the selling subunit say is, okay, below $80, we're not gonna sell, right? So below $80, the transportation unit will say, we're not gonna buy from the GulfMax and transport it to the refining division. Otherwise, they will be facing loss, right? And then the maximum price comes from the purchasing subunit. And actually, it looks a little bit more trickier. But actually, this is what we have talked about in this scenario right here. Here we talked about a setting where the capacity is unused and the competition is imperfect. And here we said that the market price is not always the right transfer price. The transfer price may be lower than the market price, and it's gonna be lower than the contribution margin of $8. So usually for the maximum price, it comes from the minimum of the contribution from the internal transaction of the purchasing subunit, or the market price of the purchasing intermediate product, right? So the market price of purchasing the intermediate product from the refining division perspective was what? It was $85, right? And how about the contribution margin? Let's figure it out based on the the petroleum example. So from the refining division perspective, the contribution is gonna be the selling price of $190 to the external customer minus the variable cost per barrel of $8, which reaches $182 per barrel. But here we need to be careful. We can't be comparing $182 with $85 because the unit is different. Here it's $182 per barrel of gasoline, whereas the market price of $85 is the $85 per barrel of crude oil. Then, in order for the apple-to-apple comparison, we have to shift the $182 per barrel of gasoline to per barrel of crude oil. But remember that we know that it takes 2 crude oil to generate a barrel of gasoline. What we can do is then we can divide 182 by 2 to get $91 per barrel of crude oil. Okay. Now the minimum of these two is $85. Okay. So it's always not the case where the contribution margin is lower than the market price. Sometimes the contribution margin may be greater than the market price, so that the market price can be the minimum price in this range. Okay. But I have another comparison example below. If the market price is $100 instead of 85 and the contribution remains to be 91, then the maximum acceptable price for the refining division is going to be $91 per barrel of crude oil instead of the market price of $100, right? And think about why. If the market price of $100 is going to be the maximum, then the refining division may actually lead to a loss, right? Think about the same example that I've shown you earlier, okay? So the range is going to be 80 to 85. Below $80, the transportation division will not have an incentive to purchase Gulf Mex and deliver it to the refining division. Above $85, the refining division does not have incentive to buy more than the market price, right? If they can buy at a market price, why would they buy even above market price, right? So it's going to be between 80 and 85. So the negotiation is going to be between this. That's what the hybrid transfer price is about. Negotiated pricing is one of the common hybrid methods, and it comes from the bargaining power of different subunits. Another way they can set the price within the range is based on a proration. Okay. If we set the mid price of $82.5, then it kind of ignores the relative cost incurred by two divisions. What does it mean? Let us come back to the two division case. So let's say in order to handle and transport 100 barrels of crude oil, the transportation division's variable cost would be 100 barrels per crude oil times $1 per crude oil, right? Which reaches $100. On the other hand, the variable cost incurred to refine 100 barrels of crude oil is going to be 100 divided by 2, right? Because this is the amount of gasoline that is produced times $8 per gasoline, right? So $400. So in order to handle 100 barrels of crude oil, refining division would incur 4 times more cost than the transportation division. And actually we can take this into account when we prorate. right? So out of the $5 difference in the range, so $5 difference means $80 to $85, right? Transportation can keep $1 out of the $5 difference, right? Then therefore, the transfer price can be $80 plus 1, $81. Okay? This is one of the reasonable way to take into consideration the relative variable cost incurred by the two divisions when we are setting up a transfer price. Okay. Now I'm gonna also talk about the general instruction for setting a minimum transfer price. In order to set the maximum transfer price, it was the minimum number between the contribution margin from the purchasing unit and the market price of purchasing intermediate product. For the minimum price within this range, it's also slightly more sophisticated. And it comes from this equation. Incremental cost per the selling subunit incurred up to the point of transfer plus the opportunity cost per the selling subunit. Okay, so incremental cost means the additional cost of producing and transferring the product and service by the selling subunit, right? And the opportunity cost is the contribution margin the selling subunit is giving up by transferring the product or service internally. All right. So let us look at three cases. And three cases we're going to apply when doing business with GulfMex. The first case is when the market is perfectly competitive, right? Meaning you can always sell the intermediate good to the external market, and the selling subunit therefore has no unused capacity, right? I mean, think about it. If the market is perfectly competitive, then you can always sell the good to a lot of buyers in the external market. Therefore, there is no unused capacity. You can always sell, right? Now, let us think about both cases, incremental cost and opportunity cost. The incremental cost for the selling subunit comes from the purchasing cost from the GulfMex of $79 plus the variable cost incurred of $1. So it's going to be $80. How about the opportunity cost of transferring to internal purchasing unit, the refining division? Well, you actually give up some contribution margin. For how much? For $85 that you can always sell to the external market minus the variable cost incurred, so $5, right? So when you add these two, it's going to be 80 plus 5, $85, right? And note that the max price in that range in the hybrid pricing case was 85. So in a competitive market, there's only one point, $85, which is again the external market price. Second case is where the internal intermediate market exists, but that is not perfectly competitive, right? Meaning there's not always enough buyers or sellers in the market, and you can always also set the price by yourself rather than taking price from the external market. And then the selling division will have a unused capacity, meaning they can have some capacity left to sell to the internal division because they cannot sell to the external market. Okay, so then incremental cost is $80 as always. And for the opportunity cost, how much are you giving up by selling internally? Actually, in this case, it's 0. Why? Because think about it. the reason why you have unused capacity is because you cannot sell to the external market, right? Therefore, there's nothing you're losing by selling to the internal refining division. So it's going to be 0. Okay, so $80 is going to be the minimum transfer price. When there's no market for the intermediate market, well, it's going to be much easier. Incremental cost $80, and if there's no market, you're also not giving up anything, therefore it's 0. Okay. Now, in the next video, we're going to look at 3 different cases on setting these transfer prices.